Hey guys, how's it going? Today is Tuesday, June 13th. It is 4:04 right now. This session is a one-on-one mentoring session with Hussein. The chat's going to be closed because this is going to be a one-on-one, just me and Hussein. You guys are free to sit in and listen. You guys probably have the same question that Hussein has, so it might be beneficial to a lot of you guys. So I'm going to finish setting this up and then we will get started shortly. A couple of things here. There's a few more things here to update. And we should be good to go. Get this link sent out to Hussein. All right, just gonna wait for Hussein to appear, and then we'll get started shortly. Hey Hussein, how's it going? All right, let's give it a few moments for you to get settled. All right, looks like we are good to go. Hey Hussein. All right, cool. So I think this is our first one-on-one session. So basically, this session is all up to you. So whatever you want to cover, you can ask me whatever questions you like, whether it be trading, trade psychology, I mean, whatever you have. Anything that I can help you with, Hussein, feel free to put any questions in the chat, and then we'll knock out everything that you need help with. So any strategy, doesn't matter, any strategy, any concepts that you might be a little confused with, examples that you want to see, whatever you want, anything that you want, we'll cover, and we'll run this session until we've covered pretty much everything that you need help with. So I'll leave the floor open to you, and I'll wait for you to type up your questions, and then we can cover them as we get them in here. So all right, Hussein, I'll give you some time to type it up. And if you want to record this session on your end too, Hussein, you can do that as well, because I know you've recorded it in the past. If you want like a higher quality video. Otherwise, we are recording this on the YouTube stream, so I will give you a link once it's once we're done here. Okay, perfect. So Hussein said, I just wanted to ask, I wanted to take some advice with regards to passing 100K FT mode challenge. I'm planning to go with liquidity push strategy. Sure. So with the strategy here, Hussein, do you plan on only taking the one on like the first one, or do you plan on taking other liquidity that pretty much appears? Because sometimes we'll have that first one, and then like for today, there was like more liquidity that got hit. So it just depends on like which one you're looking to do. I can probably break it down for you. So what you would do is you would basically set it up depending on how many trades you plan on taking. So I think you should probably think about, how many trades you plan on taking. And then we can go from there. So let's see. Yeah. So Hussein said also I'm planning on taking the first liquidity with 100 pips take profit. This could end up with me winning more trades with smaller TP. Gotcha. Okay. So you're looking for mainly the first one, right? So if you're mainly looking to take the first one, and I'll just put everything up right here. So you're planning on doing a 100K FTMO account, right? So 100K FTMO account. Your max daily drawdown is 5%. Which is also 5,000, right? Your max total drawdown is 10%, which is 10,000. So basically, these are going to be your parameters, right? Your main focus is going to be the max daily because your total drawdown is not really going to matter. You're going to make it back. If you lose one trade, you'll make it back on the next or on the one after that or the one even after that. So for this here, so I'll just put some lines here. To prevent loan account or violating daily drawdown, you only risk 3% per day. So if you risk 3% per day, you should be fine because 3% you're still going to be within the parameter. So you can basically take on the full risk, but you'll be able to avoid getting caught and getting that account blown. Because if you do 3% risk, if you lose one day 3%, next day you'll make it back. There's a couple different ways to do this. I'll give you a couple different options. They're going to have their own pros and cons. So 3% risk is 3,000. So use these lot sizes. So if you're doing max lot size will be a 100 lot. So your max lot size should be 100 lot. So if you do 100 lot with a 300, so I do 100 lot times 300 pip risk, 300 pip stop loss equals 3,000 risk. So basically you should be using 100 lot when you take the trade. If you're only going for 100 pips, and I'll show you the different types of ways that you can apply this, because there's not just one way to do it. I mean, it just depends on your preference, because sometimes, like for example, yesterday, I took the first trade with 3% risk, and then on the next trade, I only took a 1% risk. So if you want to risk 1%, then use only 100 pip stop loss. Risky because I hit stop loss too early. So it's safer because less risk at play. So I'm just going to give you a couple options here. Hussein, because there's not just one way to do it. It's just, it depends on your confidence with the trade, and if you feel that it's going to pull back or not. Because sometimes you'll see that price just never pulls back, right? Sometimes it goes straight to TP, or sometimes it retraces and then it goes straight to TP. If you want to risk 3% full risk, then use 300 pip stop loss. Risky because more risk at play, but safer because odds stop loss getting hit early is likely. So basically, you have a couple different options here, Hussein, if this makes sense to you. So your max daily drawdown on a 100K account is going to be 5%. You should never get anywhere near that. So you should only be risking about 3% per day, especially if you're only looking to take that very one trade. And then there's two different ways to play this. So what you can do here is the first option. So the first option is you'll use 100 pips, you'll use 100 lots, but then you'll use 100 pips stop loss. If you want to be actively watching the play, what you can do is you can do 100 pip TP and 100 pip stop loss. If you're actively watching it, as soon as price hits your liquidity, you hit buy or sell. And then if that hits your stop loss, then you can re-enter. So you basically have like, I think that this way is going to be more beneficial for you. This right here, but you have to be actively managing it. Like you have to be paying attention. So let me read your question again. So Hussein said, so I enter and exit manually. No, so what I would recommend for this is you would use a market order. So I would recommend that you use the FTMO Quick Trade Manager. And what you should be doing here is you should have your TP stop loss set to 100 pips. So in those two boxes, I'm not sure if you have a Quick Trade Manager set up, but you should have 100 or you have 1,000. The number is going to be 1,000, but it's going to be 100 pips. So you put 100 in each. And so what will happen here is if you get stopped out, you can just hit buy again and then have another opportunity to, get right back in. So if you do this, you have basically 3 tries. For this, you have 1 try, and this is going to be the easiest, but it's going to be a little more riskier because if you lose a trade, you're going to lose 3%. It just really depends on the person because I've explained this to a couple other people. A lot of people like to do this one right here. But again, it just depends on your preference. So if you want to actively be managing it, and like say, for example, let me see if I can find the liquidity from today. Where is the liquidity from today? I'll go and mark it up real quick so that we'll use today's example because today the liquidity went straight through, right? So I think it was, let's go over here to 6:30. Let's go to the other chart. Let's just go to the liquidity chart. It's going to be easy for us. So I don't have to make a. Sorry, we see my dog's barking. I'm gonna make him be quiet for this. Okay, I'm back. Sorry, my dog was barking. Let me go over here to 6:30, and we'll use today as the example. Okay, so let's go over here. 6:30. I think we were on the daily time frame, right? That was a liquidity for today. Where was it? I think it's already marked up, right? For some reason, the daily. Let me go back from here. Daily time frame. I think it was this. This was the liquidity level. Okay. So it's the 1 minute. Okay, so yeah, let me go back to 6:30. Okay, so here is the liquidity. Let me just go forward a little bit. Okay, so if you remember from this morning, this was liquidity that we were following. So like I mentioned, there's two different ways to do this. One way is to, when price reaches this point right here, I probably wouldn't use limit orders on these trades. If you're doing just one trade a day, Hussein, you should probably just enter right away. So for example, here, if you're doing one trade and then you hit your, you get to your entry right here, then you just automatically hit your TP right away, right? That's going to be best case scenario. If you remember from yesterday, price kind of like went up a little bit and then it pulled back, right? So if you remember yesterday for the liquidity push, it went up slightly and then it pulled back. So it would have stopped you out right here. But if it stopped you out right here, then you can just take this loss. And then when it comes back up, you have one more opportunity to make or you have two more opportunities actually, because you haven't risked as much. So same thing again right here. So you would have lost 100 pips right here already. And then right here, you're going to be having the second opportunity to make entry. And then on the second one, I think yesterday it tested twice, right? The first time it went up, it didn't hit. The second time it went up, it didn't hit again. And then the third time, it came back later and then it went straight through, right? So you can see right here, you have three different opportunities to make entry if you're doing this 100 pip stop loss. If you're doing a 300 pip stop loss, then in this situation, if price comes down 300 pips, then you would hit your stop loss, right? And then you can't make entry. At that point, you already lost, however much you went in with. So let's see, back to your question here. You said, yeah, 1% risk with 100 pips. TP stop loss may work better as it gives me opportunities to recover from the losses. Only question, will it impact the win rate? So the win rate doesn't matter, because if you're doing a 300 pip stop loss, your win rate is you're slashing your win rate into three different trades. Because if you do a 100 pip stop loss, you have three opportunities to match up with this win rate. So one trade is worth 300 pips, right? So if you lose one trade with 100 pips, it's not a full trade, right? Because you only lost partial of the trade. Your stop loss was technically down here, so you had opportunity to make that back, right? So your win rate's not going to matter, because your win rate's going to be different. Your win rate is going to be dependent on whether does this make sense to you, Hussein? I just want to make sure this makes sense, because I think you're kind of confusing it a bit. Your risk is going to be different. So if you have a 300 pip stop loss, this is a 3% risk. If you do a 1% stop loss, that's a 1% risk, right? So if you do a 3%, yeah. So I think you're still confusing the two. So let me show you. If you do 1% risk, then you can lose 3 times to equal 1 loss. Does that make sense? If you do 3% risk, then loss. So does that make sense, Hussein? Because it's different. So if you do a 1% risk with a 100 pip stop loss, then you can lose 3 times. Like you can try 3 times to get your 100 pips. If you do just 3% risk, it's just if it hits your stop loss, then you're done for the day. But if you do this, so like I give you two different options here. If you do this one right here with 100 pips, you can lose 1 time and then you can go again and you can go again. If you lose all 3 times, then that's it, you're done, right? But if you do this one, it's just a 1 time. You just enter 1 time and then you just let it set and forget. You don't have to deal with it. So that's what I was mentioning. Like this is easier because you just do one time, right? You just do one trade. But this is, if you're able to follow the trade, then this would make more sense. But then again, you know, if you don't have that focus to be able to re-enter, because like say, for example, it comes down and hit your stop loss, you only risk like a partial of a move because you didn't go for the full stop loss. You would be losing more trades. So yes, your win rate would be less, but your risk is going to be the same. So win rate doesn't really matter in this situation. This is a different type of applying it. It's more of an advanced way of trading. Like if you're watching it, you know, hit your stop loss, then you enter the third one, and then it makes it back. So yeah, you're going to be taking more trades. So the win rate's not going to be the same, but the risk is going to be the same because, you know, 3 of these trades are going to be equal to like 1 full trade. So you can do either way, but I mean, it's just up to preference. Like if you just want to do the lazy way, which is fine. Like for me, I even like to do the lazy way because I don't want to have to worry about it. Like sometimes you'll watch it and then, you know, sometimes you end up getting revenge. You want a revenge trade or you want to overtrade. If you have the opportunity of taking 3 trades, you're probably going to take even more trades. You might take 3 trades and you might end up taking 4 or 5 trades. And then if you do that, you might blow your account. Right? Because at that point, then you're risking 5%. So, yeah, I mean, these are the 2 different options here. If these don't make sense to you, Hussein, just let me know and I can explain it a little deeper. But yeah, exactly. So Hussein said, yes, 1 good trade is much better for psychology. Exactly. So you can trust the strategy, right? Because if you're doing it 3 times, you're not going to trust the strategy. You don't know when to make entry. But if you do it just once, then, you know, if it wins, then it wins. If it loses, then it loses. So yeah, for me personally, I would do the lazy way, like you said, but it's so there's just you know, some people in the group asked me to explain like another method where they can do a 1-to-1 risk to reward. And that's just the way that it would be done. But it's all up to preference. Let's see. So Hussein said, with a 300 pip stop loss, do you suggest me to go with 100 pip TP or 300? So it kind of depends on the day. So it depends on the market conditions. Like today, I would have went for the full move because we had so many confluences and biases telling us to take the buys. But like yesterday was kind of choppy, right? So I was saying that I may only go for 100 pips. So it would depend on like the market conditions for the day. So just listen to my analysis in the morning and I'll mention, okay, like whatever I'm doing, you should probably do the same thing. So if I'm going for 100 pips, you don't necessarily have to go for 100 pips, but that's what would be, you know, recommended. So yeah, I can't say for sure because I don't know how the market's going to move tomorrow. Like tomorrow we have news, I believe it's Fed day. So we have volatility is going to be high. So tomorrow we have core PPI and PPI, producer price index month over month, and core producer price index pre-market. So we're gonna have some volatility. So tomorrow I might go for 300 pips. Like tomorrow's like one of those days where there's gonna be a lot of volatility in the market, and I would probably go for 300 pips. So it just depends on the day. Not every day is gonna be the same. I think, yeah, pretty much every day this week there's news. There's news tomorrow. There's news on Thursday and there's news on Friday. So yeah, I probably would go for 300 pips majority of the days for this week. But like last week, the market was so slow because there was no news. You know, 100 pips would make more sense. So I mean, it just kind of depends on like what the market is providing. If the market's moving very slow, then probably just wait for my analysis to see. But if not, then you know, it's going to be day by day. Yeah, Hussein said I'll pay attention to analysis. Sometimes I fail to understand or I miss. So if that's the case, Hussein, just type in the chat, right? Or, you know, I might miss in the chat. You might want to type in the chat and just say and ask the group. But I'll usually try to make it clear. So I'll try to make it clear, you know, from here moving forward, because now that I know that that's an issue for you. So I'll try to make it clear and I'll try to mention it a couple times, before the trade actually happens. But yeah, I think, it's just going to depend on the day. Like, so for this week, we'll probably go for 300 pips. If my decision changes, I'll give you guys a heads up before we actually open the market. I'll try to get on the live sessions a little earlier too. So I'll try to get on the live sessions maybe 15 or 20 minutes earlier so that we can mark up all of the liquidity zones, and then I can give like a better analysis, because I've been, every time we get on in the morning, it's usually kind of rushed. So I'll try to get on a little earlier so that we can cover more in detail. But yeah, I think that's pretty much, that's the lot size I would use if you're doing a 100K account. I'm on a 200K account, so I'm doing 200 lot. And it just depends, it depends on you too. Who's saying, like, if you want to take lesser risk, you can always lower the lot size. This is just the max lot size that you should use. So max lot size is 100 lots. If you want to do less, you can do 75 or you can do 50. Like, if you want to take it slow, I would just use a smaller lot size because it's less risk. You're going to take longer to pass, but it'll be more guaranteed because you won't be risking too much, and you'll have more room for mistakes. If you make a mistake and you lose a trade due to mistake, you'll have another opportunity to try again. Yeah, so let's see. Let's go down your list. Hussein said, yeah, so to break it down, one should go for liquidity push strategy. Yes, I agree with that. Two, 3% risk per trade. Yes, I agree with that too, since you're only taking one trade a day. And then three, you said take one good trade and done for the day. Yep, and that should be good. That should be perfect. If you want to talk to Gion's like one of the guys that's doing this exactly. Like you can see over here, he made 2,000 for the day. He just does one trade and then he's done. So he's trade at 640, took the liquidity push, and then that's pretty much it. Then he made 3% on this trade. He has a 200K account, so 200 lots, made 2,420. He only went for 100 pips too. So, he's doing the same thing that you're doing. So, and then there's a couple other people in the group that are doing it too. So yeah, if I think that's probably going to be the easiest way for you to pass, because if you do it that way, you're not going to have more risk, right? Because if you take the high level momentum scalp, you might have a win, you might have a loss. If you have a winner, if you have like a couple wins and a couple losses per day, it's going to mess up your risk appetite. Because if you're just taking one trade, then you make a 3% risk of a win or profit, then it's going to balance the next day. But if you're taking multiple trades, then it's going to be riskier because you have to lower the risk. So yeah, I think your steps are perfect. I think if you want to pass and have like a more concrete idea of passing, I think this would be good, because this strategy worked very well. You've seen it for the past couple of weeks. It always hits. So if this is the only strategy that you're applying, odds of you winning more than losing is very likely. So yeah, if you want to do it that way, I think that'll be good. Yeah, sure. So Hussein said, one final question. Can you please show a few scenarios how to properly mark liquidity push and when it works well, and incidents when it has more chance to fail? Yeah, I'll try to mark up a couple. It's going to be a little difficult because we don't have the bias, but we'll do without the bias. So let's start off with today's. So let's go over here to 6:30, right? I'll go ahead and mark up liquidity here. It's going to take, let's go to the daily time frame. So we are over here on the daily time frame. I won't mark up the labels. I'll just mark up liquidity so you have it. It'll be easier for you to see. Second. So okay, so for this level, look, I'm gonna mark it up here. It looks different because the day has already passed basically, but this liquidity area has not been tested yet. It just looks like it's tested because the day's already passed. But if this was a live session, it wouldn't have touched yet. So we'll mark up the daily liquidity there. And I'll do this step by step. So I'm trying to, I think you understand what I'm saying, right? Because so for example, this candle right here is from today. Today's already passed because we're already in the future, but technically this is what it would look like. So this is what it would look like for the prior day. It just doesn't look like this now because the day's already passed. If we were trading and it was like 1 o'clock or like not 1 o'clock, if it was like 9 o'clock, then this next candle wouldn't have been produced, but the candle's already there because we're like a day forward. So I'm just going to mark up this liquidity. And again, this is how we mark up liquidity, right? I'm just going to go from, a beginner stance so that you understand how liquidity is marked up. So basically what you want to do is you want to mark up liquidity that has not been tested yet. Again, this liquidity right here, it hasn't tested, but it tested today. So that's why I showed that it's marked, but before today, it wasn't marked up. So you're going to go and just mark up every area of a high low that has not been tested yet. Mark it right there, right there, right there, right there. And those two levels right there. Let's go over to the 8-hour time frame. We are going to do the same thing here. Just mark up every area of liquidity that has not been tested yet. Go down to the 4-hour. Same thing here. Go down to the 2-hour. There's going to be a lot of liquidity on the bottom. So it's normal. Go down to the 1-hour. To the 30-minute. $15-minute. You don't necessarily have to mark all these, but I'm just doing it for visualization so that you can see. And then lastly, the 10-minute over here. Obviously, you know that a lot of these did not get tested today, but you just want to mark it up so you know where these zones are. And then once you mark them up, go down to the 1-minute. And this is where we would mark these up. So, oh wait, sorry, I need to go back to 6:30. Daily time frame. Okay, so these weren't here. Sorry, the charts are kind of messed up because the days passed. Just want to make sure these are proper. Yeah, I think it's good. Okay, so we'll start off right here. Market open right here at 6:30. Okay, so looking at the entry over here, let me go forward a little bit. Okay, so for this one right here, I would consider this one a little risky. Or no, so this one was a little risky, but there's different factors because this right here is the daily liquidity zone. So this is daily. There's just a couple different factors here that would play out. So we don't ever get daily liquidity, and I'm sure you're familiar with that, right? We never get it because price just never gets to these points. So this right here is actually a good area of liquidity. So normally I wouldn't take a trade or I would only go for 100 pips if price goes straight through, right? Because if it goes straight through like this, what I typically see a lot, what happens a lot is price will go straight through. It'll come here, fake out, and then come back up like that. That's usually the pattern that I see. But for this one right here, since it's a daily liquidity, this area is a very strong area of liquidity. So you can see when price pushes through here, it went straight through. So for this one, I would have went for the full, 300 pips. This is an example of a good type entry because we don't really get daily liquidity very much. The difference between it being a weak liquidity and a strong one is the time frame. So if it's a 10-minute liquidity, I might only go for 100 pips because I don't think it's a very strong liquidity point. The difference is if like there's a lot of liquidity here. So say for example, it's like a 10-minute liquidity, but say there's like a 1 hour liquidity right there and a 4 hour liquidity right there, and say there's a lot of liquidity right here, right? If you have a lot of liquidity like that, then I would go for the 300 pips because I'm expecting all the liquidity to get hit and it's going to be a strong push through. So, I mean, there's a lot of different factors that come through with it. It's hard for me to show you an example unless like we have like an actual area with a lot of liquidity sitting in one area. But sometimes you'll see like there's like a lot of liquidity just sitting in one spot like this right here. If you see something like that, then this is a good area to catch liquidity because there's going to be a lot of stop losses sitting right there, especially if you're on different time frames. So anyways, this is one that I would say is good, mainly because it's a daily liquidity. And yeah, obviously you can see it pushes right through and it goes straight to TP. So this is an example of a good entry type. We'll go to yesterday's too, and I'll show you that one. That one's a little different because there was a lot of like bad candles right before, like a lot of weak candles that happened before. It's hard because I can't give you like a set thing to look at. Like whenever I look at the charts, there's always different pieces that I'm aware of, but I don't have like a checklist. Like you look at overall buys, then you can also look at the type of candles that happened before and the market structure that happens before. If price is like consolidating before, that's a good thing because it's preparing for a breakout. If price is continuously pushing one direction, that's usually a bad thing because by the time it gets to your liquidity, it's going to have to retrace, right? So there's just a lot of factors. I think the best way for me to really show you is if you take a trade, like if you have a specific day where you're like, oh, hey, Sean, I took this trade and I lost. Can you explain to me like what I could have done differently? If we had something like that, we can pull up the chart and I can explain to you, why that trade was risky or why was it one that I would maybe have avoided. So that's probably the best way to do it. But I'll try to find some examples if I can find one. It's just hard because it happens every day. And lately the market has not been good for the past week. So basically every day last week is going to be a not good day. And you can see examples for it when you go back to those. But yeah, so yes, those are the time frames for liquidity push. It's the daily, then from the daily go down to the 8 hour, and then from the 8 hour just go down to half time frame. So daily, 8 hour, 4 hour, 2 hour, 1 hour, 30 minute, 15 minute, and 10 minute. You can use different time frames, but for me, I think those are like the most solid ones. Because like say for example, you want to do like the 25-minute time frame, right? If you look at liquidity on the 25-minute time frame, it's going to line up with like another time frame. Like say for example, you're on the 30-minute, like right here, and you have liquidity that's marked up. You can like do whatever time frame you like, but from my experience, I think those half time frames are probably going to be the most beneficial. You can do like something like this. This is all 30 minutes, and I've seen some people that go like on the 20-minute or even the 25-minute. But if you look at the high low liquidity areas, it's the same price, so it doesn't matter what time frame you're on. But I think doing half time frames are probably the best because it gives you a gap in between like the different liquidities, and you can have a big space in between. So like going from 30 to 15 to 10 is going to give you some different liquidity areas versus going from like 10, 20, 30, 40, 50. And I've seen some people do that. Yeah, exactly. Yeah. And then you mentioned you think following my live streams will help you understand and build your knowledge further. Yeah, I think it's better for me to, or for you to learn from like live market conditions. Because if I go back and show you like say yesterday, the day before that, it's not really gonna help, right? Because it's easy to nitpick. Like I can show you the markup, and then I can say like, yeah, Hussein, this is why we didn't take it. But it's better for you to understand my analysis when it's like happening real time, because I can show you my thought process, right? It's easy to like look back, like say for example, price is coming down right here, right? You can easily say, oh yeah, price is going to correct back up, or you can say price is coming down here, right? Because if you're doing live analysis, you don't know where price is going. But if we're to move forward, it's easy for me to just tell you like, okay, price goes up, and I'm like, oh yeah, of course I would take this trade, right? It just wouldn't make sense because you don't have the real analysis. You kind of have like the perfect answer, but a lot of times it's better to not have the perfect answer because it makes your mind think. So you're kind of thinking, okay, why would I take the buy here? Or why would I take the sell here? Because this, and that happened, right? So if there's a specific day that you want me to look at, saying like if you're trading a day and you want me to review it, I can review it. But I think just pulling back to like, say yesterday's live session or yesterday's liquidity or the day before that, it's not going to be very helpful to you because I'll show you an example, but that same example might not happen again for like, another couple of days. So I don't want to like show you an example and then tomorrow you're going to look for that example and then it just never happens. So then you never end up learning from it. So yeah, it's just better learning live because when you learn live, I can show you exactly. Yeah, exactly. The market changes daily. I don't want to show you one example and I'll say, hey, like, price is not moving straight here. So tomorrow you're going to look for the market to move sideways, but then it doesn't move sideways. And then you miss the entire trade. Yeah, no, live trading and forward testing is the best way to learn because it tests your psychology and your ability to analyze the market during live conditions. Like say for example, it's like 6:28, market's going to open in 2 minutes. You don't have time to think, right? You have to like think right away, mark up your liquidity, and then be ready for the market. Yeah, no, I agree. Hussein said live learning is much better. Yeah, 100%. But yeah, if there's any examples that you want to see, just let me know. But I think for sure, it's probably better just learning live because it's easier to see when the market's, well, it's easier to see it now because the candles have already passed, but it's more challenging if you watch it happening in real time. Like if one candle is pending, you're like, okay, does this look like a good candle? Does this look like a bad candle? And it's going to help your mind like kind of understand it better. But yeah, I think that's it for that, Hussein. So if there's any other questions, feel free to put them in the chat and I can help you further. But I think that's it for the liquidity push. The thing with the liquidity push is that it's not really that complicated. And I don't want you to think too much about it because the more you think about it, the more you'll be scared to take the trade. You learn a lot better when you're like thinking on your toes. Because if you think about it too much, you're going to be too scared to take the trade. But if you like follow the basics and you just see the entry come up and you take it, that's how it has to be done. It has to be very very natural. Like you have to be a natural at it. Like when you're driving a car, right? You're driving a car, you don't think, okay, do I step on the gas, step on the brake? Do I turn left? Do I turn right? You just do it. And that's really how you'd master it. It's just from practice, all from experience. Yeah, so Hussein said also at times you wait for entry to retest before entry, but in several cases liquidity do hit TP. Do I need to put a limit order in advance or I wait for the market structure? Because I feel I may miss the entry if I wait for the confirmation. That's going to be more of a personal approach, Hussein. So for me, I don't really like putting pending orders. I like to just enter right away. So like on the live session, sometimes I'll just wait for price to hit like a certain, like for example, like the liquidity push today, right? So like the liquidity push today over here, I didn't put a pending order for that. I just waited for price to go up. And then as soon as price hit the order right there, I just hit buy on my market order. So for me, I don't like putting pending orders. I only put pending orders sometimes, but like rarely I do. Sometimes I'll put a pending order because price is so far away. So say, for example, say price is close to it, right? If price is like around this area right here, I'm just gonna hit a market order. I'm gonna hit buy. But if price pulls down, like say, for example, let's say, like way down here, like how it was on open. So say, for example, this is liquidity, right? If this is the case and price is like right there, down here, and I need price to go up here for the retest, then I would put a pending order if I really want to. But most of the time, I'm not going to do that. I'm just going to watch the chart. Because I just go right away. Like if it's like this, and okay, maybe I'll put a pending order. But if not, then if price is already close by, like say for example, price is already right here, right? I'm just gonna wait and I'm gonna hit buy as soon as price gets here. Like I have my finger on the buy button, and then as soon as price gets to that point, I just hit buy, and then I'm in the position. Yes, if you saying so at the moment price hits the level, you click and enter the trade, like point and click trade. Yes, exactly. So I'm basically just waiting for price to get to this point, and then I have my thing, like my clicker on the buy button. And then whenever price gets to that point, I just click buy, and then I'm in the position. I have my TP stop loss set up already, so I don't have to do anything. As soon as price gets there, I just hit buy in the position, and then it pulls me out automatically when it reaches TP. Exactly, yeah. So Hussein said, as soon as price gets closer to the level, I should be on my toes to enter the trade. Yeah, whenever price gets like around this area right here, like close to it, at that point, your finger should already be on the buy button. So your finger should be on the buy button, just ready to click. As soon as price touches that point, so like right here, for example, like if price is this close right here, Hussein, just have your finger ready. And as soon as price touches it, you're already in the position, and then it goes straight to your TP. I know it's kind of difficult because sometimes, you get nervous or you get scared or you're not ready. But you'll get better at it. You get better over time. Like, for example, during the live session, I'm answering all these questions. I'm saying good morning to everybody. And then it pushes up and it goes straight to, liquidity. At that point, my finger's on the buy button already. Doesn't matter how distracted I am. I'll hit buy and then I'm in the position. The only reason I missed the trade today was because I took the other one. So if you remember from this morning, I actually took a different trade. I took this one right here, the SR rejection scalp. Same thing. I would have gone for the same thing on the other trade anyway. So either way, I got the win on both sides. I got the win over here. But then I also would have taken it for this one as well. So works out. Hussein said, how many screens do you suggest I should have while trading? I would say a minimum of 2. So I would have one screen for trading view, like me. I have one screen here for trading view, and then one screen for MT4. I have 3 screens, but I only have 3 screens because I have to have the chat open too. I think I posted a screenshot here of my screen one day. I forgot what it was. Might have been here. Yeah, right here. So I have one screen that's just my trading view. And then I have one screen over here is just my MT4. And I have my one screen over here is just the chat, like the YouTube and the Zoom. So you only need 2 screens. Or if you have a PC, I mean, PC might be different because you can like attach the MT4 right here, like on the corner or something. But on the Mac, it's different. I can't move it. So I have to leave it over here because if I drag it over to my main screen, it'll corrupt my platform because it's not a real platform. It's just it's a virtual platform. So that's what happened to me yesterday during the mentoring session. I kind of dragged it over. So I had to reinstall the whole program. That's why I just have a separate screen. So you don't necessarily need multiple screens, but if you can, it's preferred to have 2. So you can have because you don't want to have too much on your screen. Like say, for example, you have MT4 right here, and then you accidentally click the wrong button. You accidentally click sell, right? That's going to be the worst situation. I've seen some people do that. They have the half screen trading view, half screen MT4, and they just move their clicker and they hit the button. They accidentally enter like buy or sell. So That's like one thing that I would be careful for. But I don't know, it's just up to your preference. For me, I would recommend two screens if possible. If not, then there's people in the group who trade on their phone, which is crazy. I don't know how they can do it. Or what they have is they have an iPad in front of them and they just hit buy or sell on there. But if you do that, you can't have the quick trade manager. So I'd recommend just two screens if you could. That's like preferred. Let's see. But yeah, Hussein, if there's any other questions, feel free to put them in the chat. I can answer whatever else you need help with. Guys, if you guys are on the YouTube, sorry, I don't see the chat. This is a private mentoring session with it's a one-on-one with Hussein. So I can't see your guys' messages. I do see the notifications, but I can't see the specific question. So I do see, David, you put a question there. If you want to message me on Telegram, I can message you back, but I can't see the actual message. I just saw that you posted a message in the chat. I'm on the Zoom right now, so I can't see the YouTube. All right, so Hussein said, sure, I think all my doubts are clear for now. My trading knowledge has amplified in a huge way since I've joined you. You're a very kind and generous mentor, and your passion to teach us is incomparable to any mentor out there. Thank you for taking time. Yeah, definitely, Hussein. I'm glad I could help you. I know there's a bit of a language barrier between us, so it's kind of hard for me to explain sometimes and hard for you to understand. But no worries, I'm gonna try to do my best to make sure that you understand everything. And hopefully tomorrow you'll catch that liquidity push. I'm hoping I catch the liquidity push tomorrow too. Here, let's take a look at the daily real quick and let's see what it looks like, because I don't think there's going to be much of a or I don't know, maybe there's a area of liquidity right here for the daily. I think that's the closest one. I don't see anything else coming up anytime soon. 8 hour, there's nothing there. Daily, let's check weekly. Yeah, there's nothing there. So like the closest liquidity zone that we'll have here for tomorrow is extremely far out for a buy. So I don't even know if we'll have a liquidity tomorrow. Let's measure this. Unless like during Asia session and London price pushes up a lot, but I don't know if we'll have a liquidity push tomorrow, because the next area of liquidity for up top is about 4,000, 5,000, 6,000. Yeah, it's like 7,000 pips away. So I don't know if we'll have a liquidity push tomorrow for a buy, maybe for a sell, but maybe not for a buy. Or if price continues to move along like around this area, there may be some zones that create. Actually, there may be liquidity tomorrow. There's a 30-minute liquidity that's right here. And then, 30-minute liquidity. And then also, it's just 30-minute. There's some 15-minute liquidities here. So never mind, I take that back. There might be liquidity for up top by tomorrow. But we'll see how price moves right now during Asia session. So. All right, so I think that's it for now, Hussein. If there's any other questions, feel free to reach out. My Telegram, so you feel free to just message me or anything like that. But yeah, I think that's it. All right, guys. So I think that's it for today's mentoring session. Unless there's another question you have, Hussein, I think we're done. I have another mentoring session at 6 o'clock with Martha, but it's going to be private. She doesn't want it to be live streamed, so it's not going to be here on the YouTube. However, we will be back here tomorrow for the next live session. So. All right, guys, we're going to wrap this up. If there's any questions, feel free to reach out. You guys can email me or message me on Telegram. Otherwise, I'll see you guys back here tomorrow for the next live session, 6:30 a.m. I'm going to try to get on a little earlier, guys, maybe like 15 or 20 minutes before, so that we can really take time to mark up the areas of liquidity. And I can also give you guys a overall bias of the market before we actually start. So, all right, guys, that's it for today. If you guys